global economy is at a crossroads. Tariffs, shifting trade dynamics, elevated policy uncertainty, and divergent cyclical growth trends are reshaping the economic landscape and leading to the emergence of new investment opportunities. I'm Michael Sager. Welcome to the summer edition of Perspectives. Since Liberation Day in April, the US has been actively renegotiating trade relationships to benefit the economic well-being of the US, as well as to reduce China's influence in global supply chains. In reality, the US economy will bear the brunt of tariff-related headwinds. When all is said and done, the US is expected to raise its effective global tariff rate by 15%. This will be the highest tariff rate in almost a century. Because it is the only country engaged in a trade war on all fronts, the US economy is expected to face the most significant hit to growth with a projected 1% GDP drag over the next 12 months. By contrast, growth in Canada, Europe, and many emerging markets is expected to strengthen as any negative hit from higher tariffs is mitigated by monetary and fiscal stimulus. A rotation of growth leadership away from the US and towards the likes of Canada and Europe suggests that the US dollar is set to continue on a path of gradual depreciation. On the other side of this story is an expected further strengthening in the Canadian dollar, as well as the euro and Japanese yen. In the US, technology continues to lead the way. By contrast, the broader S&P 493 faces challenges from slowing growth and tariff-related pressures. The outlook for equities outside the US is more favorable. Canada is focusing its fiscal stimulus on military and infrastructure spending. In Europe, Germany is launching a multi-year defense and infrastructure program, and the European Central Bank has provided significant monetary support. Emerging market economies are gaining momentum, supported by a weaker US dollar, the global tech cycle, and lower oil prices. Emerging market local currency bonds stand out. US government bonds also remain attractive, with an expected modest decline in 10-year Treasury yields, providing compelling opportunities for duration exposure. By contrast, we prefer an underweight position in Canadian and other developed market sovereign bonds, reflecting a combination of lower current yields and upward rate pressures driven by higher fiscal spending and the expected growth recovery. At CIBC Asset Management, we remain cautiously optimistic in the economic and investment outlook. Broadly speaking, we think markets will continue to focus on the improving outlook for economic fundamentals. That said, with downside risks to our constructive economic outlook still pronounced, bouts of heightened market volatility are to be expected. For the full Summer Perspectives report, please visit the CIBC Asset Management Insights Hub.